This is my June trading recap, where I placed hardly any manual trades and suffered a 10% drawdown in my automated strategies. I'm Manir, also known as Ghost of Trades on Twitter, and I also run Unbiased Trading. It's an agency where you can hire quant developers to help backtest and automate your trading. Let's get straight into this month. Now, these videos are a bit more ranty, so please, if this is your first video, a lot of my other videos are more packed with knowledge and value that I try and provide, whereas these are me simply going over my trading month and providing some transparency and just some of my thoughts basically on the month. So first is my small cap trading. So as you can see here, this is TraderSync where I upload all my trades. There was only 3 trades actually taken this whole month, and overall it resulted in about 2,000 in profit. I think minus about 100 and something in locate fee, so about 1,900. I had a trading friend come over to stay with me, and he's actually still here. And we've been mainly focused on automated strategies and unbiased trading, and also Ask Edgar. So primarily, I took this month to really focus on those 3 things, and I didn't want to cause either inefficiencies with my actual manual trading, whether that be lack of attention, overconfidence because someone else is in the room, or trying to make sure that a trade is profitable, all those sort of things that I've probably suffered from previously. So I really just focused on, hey, I'm not going to take any trades, just going to focus on the 3 things that actually matter, and to really give as much attention as I can to those. End of day, I really don't want to risk any money if I'm not 100% focused executing, especially when it's manual execution. I'm fine letting my automated strategies run as I did, and we'll get into that in just a second. But I really know how easy it can be to slip up with your manual execution when you're not in an environment that you're used to. And I'm definitely not used to trading in front of people or something like that. So how did my futures automated strategies do? If any of you are unaware, futures stand for basically ES, NQ, pretty much any futures instrument. So crude oil, gold, those sort of instruments. Primarily, my portfolio runs on indexes, so ES and Q, and then there is a couple crude oil and gold as well. Now, in case this is your first video as well of mine, I run about 7 of those futures algos, and last month was a record month of about 23% returns on my actual capital. As I will always state with this, that percentage return does not mean that can be extrapolated out to if I was managing $1 billion or something like that in capital. Some of those returns is definitely dictated by me using a smaller size account. It's roughly mid 5 figures. So, I'm not trading on the most capital, and especially because of futures leverage, it's actually really not that much capital you actually need in there to maintain that amount of size. As we can see, this month started off very tough. So coming off last month with 23% returns, I was extremely happy with that. And I was kind of bracing myself just in case, because I do know sometimes it can be very unlucky. And the next month, it is what it is. Instantly went into basically a 10% drawdown during that month. During the beginning of the month. So that was extremely tough. And then we later recovered pretty much all of that and actually had a peak of around 15, well, I think it was about 17% returns, which was amazing. And I was, incredibly happy during that time when I checked that over. But then it basically just drew down again back to about 6% returns end of the month. So overall, it wasn't a break-even month, but it definitely wasn't anything crazy. And it was a lot of emotional whipsaw to kind of go through that. And I think that's something people don't often talk about with automated trading is, obviously your emotions aren't really on the individual trades themselves, but I still have to wake up every day or every week when I check the kind of portfolio balance, and you can see a change. It's going to cause you, a bit of emotional differences when you actually witness that live. So there's always going to be emotional whipsaw with that. And definitely that was kind of one of these months where there was a lot of whipsaw with it. But overall, I'm happy that I didn't, break any rules. I didn't change any of the strategies. I didn't stop any of the strategies. Obviously, if they needed to be stopped because they went into significant drawdown, then I would have, but nothing, really hit my red alerts. So, there was no reason for me to do anything. I just had to wait out and see how performance happened. So overall, still happy to, I guess end green on the month, but definitely was a stressful month. Now let's get into the notes. So I want to talk a bit about handling drawdowns, what I think about and how I personally do it. This is through techniques and obviously just some general notes as well. Really anything I could think of on the fly that I wanted to mention. So first is obviously diversify across multiple strategies. This is basically the idea of just having a portfolio of strategies that's uncorrelated so that they can negate each other's risks. And this really can help to spread out the risk across there. So I think the main strategy I had drew down about 30% during that 10% time. Now, I do know that strategy is highly volatile and I have less size on that particular strategy, but plus the other strategies were maintaining some of performance. That's how I ended up with only around a 10% drawdown. So, if I had only been trading that one strategy and for whatever reason I had allocated all capital to it, then yeah, it would have been an incredibly stressful month because it drew down quite a lot. So that's the benefit of having multiple strategies and being able to spread your risk out like that. And then obviously we'll go into some kind of risk parity stuff as well. And then another point here is, the basic kind of just combining trend following and mean reversion strategies can be a really good way to spread that risk as well, and also maintain kind of performance, because mean reversion strategies are going to do terribly when it's trend following, and trend following is going to do terribly when it's a mean reversion kind of market regime. So, having those two to balance out each other, you can normally get better risk adjusted returns by combining them. Next is implementing proper position sizing. So for the most part, you probably want to use some kind of position sizing algorithm. Algorithm's sort of a fancy word here. It could really be anything. It could be fixed fractional sizing of your capital, so percentage of how much capital you're using, and it could be something more complex if you want to base it off how recent performance is going. Additionally, this is a bit harder to do in futures. The reason for this is futures, you can't have a fractional part of a contract, meaning, if you have one mini contract, there's going to be a baseline amount of risk there based on the amount of ticks that you're using to risk, as well as, you could move down to micros, but micros do perform slightly, very slightly, a bit differently in volatility, which can change indicator values. And then additionally, to switch a whole instrument can sometimes be annoying as well. So there's multiple things to consider there. You can't ever do full fractioning like you can kind of with shares, or I guess with shares, you can do it a lot better anyway. So normally in futures, you really have to be careful about how much capital you're actually allocating and how much of those contracts you're allocating per of that strategy. So most of the time, most of my strategies are running on minis, meaning I'm normally only using one mini contract or max maybe 2 or 3. And then any strategy that's like position pyramiding, for example, like, having multiple contracts, that's definitely going to be on micros. And that allows me to do the risk better there. Next is using some kind of risk parity techniques. So you want to allocate maybe your capital based on the risk contribution of each strategy. So as I was saying before, one of my strategies is a lot more volatile based on my historical backtesting and robustness testing. So I allocate a smaller amount of risk to that actually particular strategy because of that volatility. And this is just a really good way of making sure that your portfolio isn't overly allocated to a more risky approach of your particular strategies, which is going to cause drawdowns to be a lot harder to actually maintain and understand. It's going to make it a lot harder to keep a cool head during that drawdown and not do something stupid like change the whole strategy or take out a strategy, preemptively. You can also, as I was mentioning, rebalance basically allocations periodically to maintain your desired risk levels. And then lastly, we have backtesting with realistic assumptions. This is really important. When you're backtesting, make sure you're including, transactions cost, slippage, and any other real-world factors in your backtest. Not for just the only reason of obviously you want proper backtesting, you want proper testing that actually represents the real environment as best as you can, but you also want it to give you good expectations of what to expect with that strategy when it's live. If I had not known that one strategy was more volatile because of my testing, I would have maybe taken that 30% drawdown as that strategy is completely terrible and I need to cut it immediately. Now that 30% drawdown was pretty extreme, but still, if I had not had that expectation, then I probably would have cut that strategy, to be honest. If I was thinking emotionally about it, definitely during that time was very stressful. I probably would have just deactivated it, put it on a sim account and kind of not let it continue live. And then after that time, it actually did recover most of its drawdown by the end of the month, which allocated some of that to that 50% peak return during the month. So making sure you have realistic expectations via your backtests can really help you maintain a cool head during that time, making sure you're not doing anything stupid like overfitting the strategy or deactivating the strategy preemptively. And it can also just make it easier to actually do the risk priority side of things, be able to balance and allocate capital correctly based on those strategies. That's pretty much everything I wanted to talk about with this video. I hope your month went well.